Okay, I think we're at critical mass. So let's make a start. Dennis, I wondered if you could put the mic on in Kilimanjaro. Great, thank you. Well, good afternoon, everybody. This is our first FSD Africa 101 webinar. My name is Joe Huxley. I'm Director of Strategy at FSD Africa. And today we're going to discuss inclusive capital market development and why it matters to Africa. But before I hand over to Evans, Osano and his team to introduce themselves, I just wanted to make a couple of quick housekeeping points, if I may. The first one is, if you just joined us, could you please put your mic on mute until we invite some questions, just to minimize the echo, to make sure everybody can hear clearly from Nairobi. And then we're going to pause for questions during Evans's presentation at 2 points. But we'd like you to ask your questions in the chat facility on Zoom if you have access to it during the presentation. And I'll pick out a couple of questions from there just during the presentation so we don't disrupt the flow too much. And then we'll have much more of an open discussion at the end of the presentation. Okay, so over to you, Evans, to introduce your team.
Yeah, thank you, Joe, and welcome everybody to this webinar that we're having. But before I start the webinar and what we'll be covering today, let me take this opportunity to introduce myself and the team. So my name is Evans Osano. I'm the Director for Financial Markets at the FSD Africa. I have over 20 years of experience working and supporting capital market development and investing in the markets. Experience overall in about 30 countries in Africa and outside of Africa. But outside the work, I enjoy the arts, particularly performing and the visual arts. I'm a published poet. Many may not know that. And I'm also very passionate about environmental conservation. We have a team of 5 specialists and 2 project managers. And with me here today, I have Vimal Palmer, who is a capital market development specialist. Vimal has over 10 years experience covering corporate finance as well as security. But outside of work, Vimal loves doing philanthropic work. He enjoys nature and he enjoys sports. He tells me if he wasn't in FSD Africa today, he probably would be a footballer somewhere in Europe and probably looking to retirement, but he's here now supporting capital market development in Africa. And then we have Victor Nkiri, who is also a specialist. Victor also has more than 10 years experience. Started off as an equities trader, then moved on and became a fixed income trader and a bank treasurer. And besides that, he loves community development. He's an enthusiastic farmer. He loves the arts and the mountain climbing when he can find the time out of his very busy schedule. And then we have Brian, who is an analyst in the team. Brian is also a fitness enthusiast, and he's actually, he tells me, a certified fitness instructor. And then Mary Njuguna will be joining our team in the next 2 months. She's coming to us from Capital Markets Authority, where she's responsible for corporate approvals and licensing, so it brings very strong regulatory experience of over 10 years. But outside work, Mary also loves farming. She likes spending time with children, and she tells me she's a favorite auntie to many. So that's the team that we have. And in addition to that, I mentioned we have 2 project managers managing our bond market infrastructure project as well as the green bond program. So that is the team that support the work that FSD Africa is doing to develop the capital markets in Africa. So for the webinar this afternoon, we want to share with you a couple of slides. And it's really basically to give an introduction to what capital markets are, why they matter in Africa, what can we put on the, let's put on the slides on the screen. So we will be looking at an introduction.
Hello, Evan.
Yes.
Hello, we're having a hard time hearing you. We're here at USAID Rwanda.
Okay.
We're having quite a hard time hearing you because it sounds like you're in a kind of a large room and with an echo. We were wondering if you could speak maybe closer to the microphone when you speak.
Okay, thank you very much. Hopefully, I'll also try and speak a bit slowly so you can be able to get it as well. So as I was mentioning,
yeah,
I don't know whether that is better and clearer for everybody who's listening. So we want to basically cover, yeah, thank you very much. So we want to cover just a couple of points around the capital market development. First of all, what are capital markets? Why do they matter in Africa? And what's the difference, or what is the connection between inclusive finance or financial inclusion and the inclusive capital markets? And we'll also be able to share with you what FSD Africa has been doing to support capital market development and some of the lessons we have learned from supporting capital market development in Africa. So that is the outline of what we're going to discuss today. We'll have an opportunity, as Joe mentioned, for questions and answers, and we'll be able to go deeper in addressing any of the issues that you may want us to cover. But first of all, if I can start then, what are capital markets? So essentially, capital markets are part of the financial markets that facilitate the raising of long-term capital. Usually we say over 1 year, and we use various instruments. The two main instruments are debt and equity. And when you talk about debt, these are normally bonds, or they are very similar to loans, but they are long-term and they are issued by governments, they are issued by municipalities, they can be issued by companies as well. They are similar to loans, as I mentioned, but they have standard features which makes them easily transferable. In addition to that, they focus much more on disclosures rather than having collateral arrangements. And then equity markets, which are basically shares, represent ownership in a company. These two securities can be issued in public markets, such as the stock exchanges, or in private professional markets. Typically, when we talk about primary markets, we refer to the markets where the initial capital is raised, and then the secondary market is where these securities, once they have been issued, can be traded and transferred to other investors who are interested in participating. But the public markets generally represent a very small fraction of the long-term financing market. So when we talk about capital market development, it's always good to put it in perspective, and it's always good to try and focus not just on the public markets, which is what we recognize easily, the stock exchanges, but also the broader spectrum of the markets that can raise long-term financing. Capital markets play a very important role in the economy, so they support mobilization of savings, long-term savings. They also facilitate the financing of priority sectors, and that can be in the real sector, such as in the roads or power or enterprise financing, but they can also support investments into the social sector, such as education and the health. Capital markets also support improve the risk management, and they do this by reducing foreign currency and refinancing risk, especially if you're looking at domestic markets. They encourage an efficient allocation of capital in the economy, and therefore they are productivity enhancing. Capital markets also improve corporate governance. As you know, improved corporate governance leads to improved access to financing and also reduce the cost of capital that is available to entities. And then it also democratizes ownership of assets in an economy, because then the assets in the economy will be in the hands of very many investors. So they are able to participate in the well-being of the economy. They reduce transaction costs as well by improving efficiencies in the market. And they also provide a strong signaling effect on the economy. This is mainly because markets are generally future-looking, and therefore the performance that we see in the market reflects investors' perceptions about the economic potential or industrial potential of different investments. So what are the differences between inclusive finance and the capital markets? Since early 2000s, there's been a strong focus on inclusive finance, also known as financial inclusion or access to finance, but which we generally collectively understand as finance for all. But in recent years, there has been an increasing appreciation of the broader poverty reducing role of the financial sector through inclusive capital markets. These two markets are not disconnected. They're actually very strongly linked. So long-term financing that is available through the capital markets supports growth. So it enhances productivity. It ensures there is enough investment that is going into financing infrastructure or the corporates. And therefore this creates jobs and improves people's incomes. And therefore they're able to participate in the markets in a much more meaningful way. Long-term financing also improves access to services. So if the government issues bonds, the proceeds can be invested in the health facilities, in education, in markets, and this generally improves their livelihoods. And then they also provide as savings instruments for the underserved segments, either directly, so for example, through the use of mobile-enabled platforms, similar to what we saw in Kenya with the Makiba product, or by the investment opportunities they provide for collective investment vehicles, such as pension funds or insurance companies, or even unit trusts or mutual funds. And then the capital markets can also finance or raise financing for intermediaries, such as banks or microfinance institutions, and the financing can come in the form of debt or equity, and these institutions can then on-lend these proceeds or can be better placed to provide services to a large segment of the society, either based in the rural areas or urban areas. And therefore, from our perspective, we believe that inclusive finance and capital markets are both required to reduce poverty and create opportunities for the underserved populations.
Evans, I wondered if we could pause there just for a second to invite questions from anybody on the chat, just to make sure that we're nice and inclusive.
Sure.
If you have a question, please write it into the group chat. But Evans, maybe I'll kick off. Just to give an example of one of these links between capital markets and financial inclusion, I wondered if there's a transaction that comes to mind that links long-term finance to products and services being made more available to underserved segments. Is there a particular deal that gives a good example of this?
Yes, there are very many transactions, and I think I'll provide maybe examples. So for example, the microfinance space, we've had quite a number of microfinance institutions raising bonds in the market, and then they use the proceeds to on-lend to, say, farmers or to on-lend to small businesses in different parts of the country, and that increases, of course, inclusion. So that's one example that I can provide, and we have quite a number of those MFIs that have issued bonds in the market, including Payport Zambia, we've had Musoni in Kenya, we've had Platinum Credit in Uganda, and there are quite a few others that have issued bonds in the market and then use the proceeds to on-lend to individuals as well as to small businesses.
Great, thanks Evans. We've got a couple of questions coming in. We've got one from Grace, and she's saying that the term inclusive finance is often used loosely. Could you clarify, Evans, what this is used to mean today in the context of the webinar? What do we mean by inclusive finance?
So inclusive finance, as I mentioned, is a term that we use to indicate, programs that provide financing for all. So making sure that individuals who don't have access to financial services do actually have access to financial services. So it's finance for all. That's how we use it in our terms.
Great, thanks, Evans. And then one from Duncan. He's asking.
Traditionally, traditionally just focus on the short end of the market. So, but we are also saying that it's important to start looking at long-term financing as well, as really a broad definition of inclusion.
Okay, great. We've got a lot of questions coming in, but I'm just going to put one more to you for now before we move on, and we can catch up with the other questions later on. Duncan and Anne-Marie are both asking about the difficulty that financial intermediaries have in the financial inclusion space, raising capital from long-term finance markets. Can you talk about some of the challenges that some of these MFIs and other intermediaries might have raising capital from capital markets?
Yes, Joe, if I could pause on that one, maybe I can address it later in the presentation, because I will address, as part of the challenges that are facing capital markets more generally in Africa. So I could pause on that. Okay, great. Yeah.
So Evans, perhaps we'll move on and answer a couple of the questions as we go, and then take a few more a bit later.
Yeah, thank you, Joe. So we've discussed about capital markets. We've talked about the connection between inclusive finance and capital markets. Let's just now look at why capital markets do actually matter in Africa, and there are a number of reasons. The first one is around the investment gaps that we have for priority sectors such as infrastructure, housing, or even the social sectors. Our own estimate is that we have a funding gap of about $300 billion per annum that is needed to go into these sectors. And a lot of this funding cannot come from the traditional sources, so we do need to develop our capital markets to provide a complementary source of financing. We do also have fundraising pressures. As you know, over the last 10 years, a number of countries in Africa have joined the low-income category, according to the World Bank, and that basically means they have less access to concessional funding, say through the International Development Association window. And of course, we also have constrained market conditions in a number of places where if these companies or countries are looking to raise money from Eurobonds, for example. And then we have a number of global challenges that need financing. Climate change is one of them. Urbanization is another one that requires capital markets to be able to finance those challenges. And then purely from a risk management, as I mentioned before, capital markets are a very powerful tool for reducing risk because they manage foreign exchange as well as the refinancing risks much, much better. We've seen examples of the global financial crisis in Asia and the impact it had on the economies there, and also earlier on in the 90s in Latin America. And we believe that with a more robust and efficient capital market, domestic capital markets, we can be able to be more resilient as economies. Capital markets also create opportunities for the investor base, and that investor base is growing in Africa. So they need instruments in which they can be able to invest and generate a return that can be able to meet the needs that people are saving towards, say, their retirement. And then finally, we do need the capital markets to diversify the financial sector. At the moment, the financial sector in Africa is very bank-centric. I think over 75% of the financial sector in Kenya, for example, is banking dominated. So we do need to try and diversify that. Okay, so let's move to the next slide. Yeah, so what is the landscape of capital market development in Africa? So the capital markets in Africa are relatively underdeveloped, so they are shallow, they are illiquid, they are not very efficient. But over the last 10 years, we've had a lot of growth in the economies of these countries. The macroeconomic environment has been much more stable across sub-Saharan Africa, which has created a better environment for capital markets to flourish. So if you look at the state of the capital markets in Africa, and I have numbers for 2016, for example, we now have about $1 trillion of assets under management between the insurance, pensions, as well as collective investment schemes. That's a lot of money, and it's been growing very, very fast because of reforms in a number of countries, like in Nigeria, in Kenya, in Ghana, in Zambia, to the pension sector. If you look at the government bond markets, outstanding local currency government bond markets in Africa is about 388 billion. That's a lot of money. And then on the corporate side, outstanding corporate debt is about $100 billion as well. Those are 2016 numbers, and they have gone up in 2017 and currently as well. So those are large numbers. If you look at the dynamics or the flows in the market, over the last 5 years, between 2013 and 2017, $53 billion has been raised by companies in the equity markets in Africa. A lot of that has come from secondary offerings of existing companies that are listed in the market. $22 billion has been invested by private equity funds operating in Africa. And $128 billion has been raised in Eurobonds by African governments as well as corporates. 85% of that as well has been raised by sovereigns in Africa. The number of stock exchanges has also gone up from 4 in 1989 to around 21 today, and that's a significant growth. So yes, the markets have grown quite quickly. They have been relatively dynamic, but there are quite a number of challenges that remain. And those challenges include, if I look at the different market segments, on the so those challenges include, if you look at the public equity markets, we have a small number of listings and very high concentrations. So Safaricom in Kenya, for example, accounts for 40% of the market capitalization in Kenya. The liquidity is low. So the turnover, the ability to sell the securities in the market is a bit low, but it is improving over the last few years. There has been also limited fundraising, particularly through the initial public offerings, But what we've actually noticed is that once a company is listed in the market, its ability to raise capital becomes much easier and cheaper, and most of the fundraising in Africa has also been raised through the secondary offerings. And then there's been low market depth, which basically means that major economic sectors are not represented in the market. On the private equity space, the fundraising has been to date largely DFI-led, so development finance institutions. We've so far had very limited progress towards homegrown industry. So pension funds or insurance companies are not investing enough into private equity markets. We've had limited exits through the public markets, and a lot of the private equity funds focus on relatively large deal sizes. So the SME segment has remained relatively underfunded. On the government bond markets, we have very fragmented issues, and which basically means that liquidity has been relatively low and unpredictable. We have very underdeveloped money markets, and we have, in many markets, settlement risks arising from the fact that the plumbing in the market, or the market infrastructure, or the market structure is not robust enough. And on the corporate bond market, I think this addresses the question that came a bit earlier. We've also had a few challenges around the issuance frameworks, which make it a little bit more difficult for companies to access the market, which makes it costly in some instances, which reduces the speed of accessing the market. And as you're aware, when corporates want to issue bonds, or MFIs want to issue bonds, they don't want to wait for 9 months before their issue is approved. They want to be able to raise it now. And they don't want to pay a very huge cost to raise the money. Otherwise, they may want to consider alternatives. As I mentioned before, the financial sector in Africa is dominated by the banking sector. And a lot of these banks are highly liquid. And therefore, in a number of instances, they provide a disincentive to issue bonds, because they can serve, in a number of cases, not too well, but they can serve, in a number of cases, the needs of corporates that want to raise funding. And then a bigger challenge is the fact that a lot of corporations or corporates are not prepared to meet disclosure requirements, which is what investors demand. So investors do not demand very stringent requirements from the issuers, but they do require disclosure so that they can be able to understand what's going on in the companies they're investing in, and they can make judgments about the safety and the potential returns from the investments. And if you look at the institutional investor base, pension funds or insurance companies, the credit culture is relatively weak. And many of the insurance companies or pension funds do not understand how to assess the credit risk, and therefore will shy away from what they consider to be relatively risky investments. In addition to these challenges, we do also know that there are also a number of institutional weaknesses between the regulators as well as the markets that generally discourage the markets from developing. So,
Evans, we've got a couple more questions if we could pause there. And there's just a comment from USAID as well about just speaking a little bit more directly into the mic if you could, and a bit more slowly. Okay. But the first question, Evans, is about risks here. We hear in the news often that the African governments are raising capital from the markets and becoming quite highly indebted. What actually happens when they default, or if a corporate defaults? What sort of risks are involved in that?
Okay. Yeah, no, thank you, Joe. Let me probably ask one of my colleagues who is in the room to respond to that. And Vimal, I don't know whether you want to respond to that question about the risks of governments and corporates, defaulting on the debt.
I think for any kind of debt issuance, whether it's government or corporate, credit rating, it plays a key role, and also in terms of the cash flows of the company. So those are some of the major risks. So macroeconomic risks and political risks play a big role. We have seen in environments where the macroeconomic situation can abruptly change, and that becomes quite probably unfit for corporates or even government to work effectively. So I think looking at that from a risk perspective can lead to defaults in any market, whether it's developed or developing market.
Yeah, but if I could just add one more thing to what Vimala said, the risk is actually greater for, if you look at the sovereigns as well as even the corporates, the risk is actually much greater when they're raising debt in currencies other than their own. So Eurobonds, or if there's a corporate that is raising dollar-based debt when their cash flows are generally in local currency, then they face much greater risks compared to a situation where you had the domestic capital markets.
Okay, thanks, Evans. We've got another question here. This one's from Rofi. Rofi's asking that a question around geography. So we're talking about Africa as a whole here, but are all African geographies ready for capital market development, bearing in mind where their infrastructure, how mature their infrastructure might be, hard infrastructure? So this is really about, are some markets more ready for capital market development processes than others?
Yes, I think the answer is yes, because when you're investing in the capital market development, you are looking at long-term investments into the future, 5 years, 10 years, 20 years, 30 years, 50 years, and beyond. And therefore, issuers who are looking to raise money in those markets need to be sure that the markets will remain predictable and all that. So investors also looking to invest in those markets want to be sure that the macroeconomic environment, the political environment, the legal environment will not change fundamentally to affect the value of the investments. So that's very important. In addition, for you to have a much robust capital market, you need institutions, you need to invest in infrastructure, you need a regulatory framework, and that can be quite expensive. So you need economies of scale. And not all the countries or markets in Africa have economies of scale. And that's why it's actually important as you develop the market, you have to think about the state of development of an economy, of a market, and see what is what is possible to do in different markets. However, it's also good to consider what kind of markets can serve this economy. So in some cases, it's not the public market that you should be looking to develop for the number of reasons that I've explained, especially the issue of scale. So in some of the markets, developing a professional market, which relies on a smaller number of institutions that understand the market, understand the risk that they're investing in, is probably something that is easier to do and something that should be considered and prioritized. And then, of course, in the capital market, there are very many instruments as well. So for specific markets, some instruments are probably more palatable. The markets will be much more ready for those kind of instruments as opposed to others. So introducing derivative instruments in some of the market might be seen to be premature. And in some cases, focusing perhaps on the fixed income markets is a way to start instead of focusing and putting a lot of resources around developing public equity markets.
Great. And there's questions around, this is from Jacqueline in Uganda, around the trend of governments insisting that mobile network operators start to list. She wonders what you think about this trend and what the effects of governments requiring companies to list might be. And she cites Ghana, Tanzania, and the potential of this process happening in Uganda.
Okay, so I personally do not favor forcing entities or companies to list in markets. I think what you need to focus much more is making the markets attractive for those companies to come to the market and raise financing. So we need to focus on building an enabling environment that makes it cost-effective, that makes it faster, that reduces the complexity around accessing the markets. And then once you've done that, then of course you can do a lot of work around advocacy, encouraging different players to come to the market and take advantage of the opportunities that are raised.
Great. Maybe, Evans, we can move on to the role of FSD Africa now and take questions at the end of the presentation.
Yeah, no, thank you, John. So FSD Africa works with our partners in 4 main ways to support market building, for the capital markets. The first approach we have is enabling the markets to flourish. So we do a lot of work around policy and regulatory reform. We support market infrastructure development. So that creates an enabling environment for the markets. And we don't stop there. So we do also a lot of demonstration work. So using our development capital and technical assistance, we support pioneering market products and the platforms that can show that the markets can work and support the different aspirations for the economies and markets. And then we also build capacity for government and the private sector players across a range of geographies. Then in addition to that, we catalyze partnerships in order to scale what we're able to do and ensure that the ideas that come, the new ideas can be replicated in different markets and geographies. So FSD Africa is different from a number of players in this space because we are an African-based institution. We have very deep roots in Africa. We have a strong network of connections between the private and the public sectors. We are neutral. We are not constrained by any specific dogma, so we can be quite innovative in terms of how we approach market development. We are nimble, which basically means we can be quite responsive, and we're happy to take a risk that most partners are not able to take. And we are finally very hands-on in our delivery. So for those reasons, we've been able to work with very many partners in Africa, both in the public and the private sectors, to support market development. So in terms of, and we are currently managing a portfolio of 12 projects across 24 countries across sub-Saharan Africa. Our vision really and strategy is to ensure that we transform the sub-Saharan capital markets into a credible source of long-term financing. So some of the support that we have includes two streams. So there's the technical assistance that we provide, and then we also provide investment through our development capital. So on the technical assistance side, we have a number of regulator support programs in Kenya with the Capital Markets Authority and with the Nairobi International Financial Center. We're also working with the Capital Markets Authority in Uganda, and we are working in the West Africa Monetary Union with the Agence Umuatit, which is a regional debt management office. We do have a number of programs that support the introduction of new products in the market. We have a Kenya Green Bonds program and a Nigeria Green Bonds program, and we've been supporting Islamic finance in Kenya for the last 3 years. We also have 2 projects supporting bond market infrastructure in Kenya and Nigeria, and we are very active supporting money market development across sub-Saharan Africa, working with the Frontclear. We have a program around the professional certification. We are working with the Chartered Institute of Securities and Investment, which is a UK-based professional certification body, and is working across 10 markets in Africa to introduce professional certification, which we believe enhances investor confidence in these markets, as well as improving the skills level in the markets. And we have a few market information and knowledge management projects. With the East Africa Venture Capital Association, we've done a study on fintech industry in the region, covering 5 countries. We are currently developing an investment toolkit that will encourage pension funds and other institutional investors to allocate more funding into private equity. And then we have a long-term finance project in partnership with the African Development Bank and GIZ that aims to improve the quality of information and the timeliness of information around the long-term financing in Africa. We've also done a study recently on Emakipa, which is the mobile-based retail bond in Kenya, to learn lessons from what has went very well on that issue, what could have worked better, and how we can be able to improve the design of similar retail bond programs across different markets. We do finally have a program with the Africa Securities Exchanges Association, again working on the information portal to improve the quality and timeliness of information around long-term financing in Africa, so that we can be able to encourage more investors into the markets. On the investment side, we have invested about $20 million into the Africa Local Currency Bond Fund. The Africa Local Currency Bond Fund supports first-time issuers of corporate bonds across Africa. And by investing in these bonds, it encourages local domestic institutional investors to co-invest alongside them. At the moment, for every $1 that the fund invests, it's been able to crowd about $7 into the bond issues. And I think that's a very good crowding in number. We also have investments in FrontClear, which provides guarantees to enable interbank money markets to function better and ensure that liquidity is distributed better between different players or banks in the financial sector, as well as providing technical assistance in terms of improving the well-functioning of the money markets. So that's just a menu of some of the programs that we have at the moment. And this portfolio really started in 2017, so it's a relatively young portfolio, but we have seen so far very strong results, very, very encouraging, and we believe that they'll be able to realize the goals that we've set for them. So for example, the program we've had with the Capital Markets Authority in Kenya has seen that 2 new policies and procedures being implemented, which have gone a long way in strengthening CMA as a regulator. As a matter of fact, CMA was nominated as the most innovative regulator in Africa. And I think for last year, it was also declared the best place to work in East Africa. And I think that's quite an achievement for a regulator. Our work with the Nairobi International Financial Center has seen the Nairobi International Financial Sector Authority Act being passed by Parliament. Just yesterday, the Minister for Finance in Kenya announced that NIFCA, the authority that will be overseeing the center, is going to become operational within the course of this year, and that's a major achievement. On Islamic finance, a number of laws were amended last year to facilitate Islamic finance, and the tax neutrality, which is very important for Islamic products, was also attained through the support that has been provided to the financial sector regulators here in Kenya. On the green bond programs in Kenya and Nigeria, we've seen Nigeria issuing the first climate bond certified green bond in Africa, which raised about $30 million. We have a very strong pipeline of potential issuers that will be coming hopefully in the next few months as well in both Nigeria and Kenya. That includes the sovereign as well as the corporate sector. And our program around the professional certification, or CSI Africa, has been implemented in 5 countries. It's now mandated in Kenya. Over 3,000 professionals in the capital markets have been trained to date, and they have sat for examinations and passed different stages of the examination process. And our work with the Capital Markets Authority in Uganda has seen a 10-year master plan for the capital markets being launched and is now under implementation. We've also done an institutional capacity assessment of CMA Uganda. A number of recommendations arising from that assessment are being implemented, and over time, progressively, we are seeing CMA Uganda becoming a much stronger regulator. So that is what we have done so far in the last year or so. We've learned quite a number of lessons from our work, and there are 3 main takeaways that I can mention. The first one is that the role of capital markets is being increasingly recognized as central to the development in Africa. It's now recognized in the AU Agenda 2063. It's at the center of AU Agenda 2063 in terms of domestic resource mobilization. It is reflected in a number of national visions of different countries, including Kenya, Uganda, Rwanda, and Nigeria. And we have a number of countries that have already developed 10-year master plans to develop their capital markets. Those include Kenya, Uganda, Rwanda, and Nigeria. And a number of other countries that are in the process of developing their master plans, including Ghana and Zambia and Tanzania. In addition, we could also say that yes, the markets may be small, but we see significant growth potential in these markets. And then finally, in terms of our own work as FSD Africa, we have seen an increased portfolio, which has been in a very short period of time. And this is basically arising from very strong demand that we've seen from clients across the private and the private sectors. the private and public sectors across Africa. We have expanded our geographical reach. We have programs now covering 24 countries, which is a combination of country-specific as well as regional programs. We have a very interesting mix of projects, and which are also introducing very interesting results and providing very strong demonstration impact. And we've been able to forge during this short period of time very strong partnerships with other entities that are interested in capital markets development. Those include FMO, which is a Dutch development institution. We have a partnership with the African Development Bank on the long-term finance program. We have a partnership with the Climate Bonds Initiative on the green bond programs in Kenya and Nigeria. We have a partnership with the FMDQ OTC exchange in Nigeria, which is the bond exchange in Nigeria, on the green bond program in Nigeria. We do also have a partnership with the GIZ and the KFW, particularly around the Africa Local Currency Bond Fund. So the results from all this work that we've done over the last 1.5 years has been very encouraging, and gives us a lot of comfort to consider, deepening this support that we're providing to different entities in Africa. So that's really a summary of the work that FSD Africa has been doing, supporting capital market development in the region, and I'm sure there will be very many questions and comments which we'll be happy to take.
Thanks, Evans. There are lots of questions on the group chat. Before we get to them, just a reminder for everybody on the webinar that you can reach Evans and his team if you've got any follow-up that you'd like to do at financialmarkets@fsdafrica.org. So there's a special email address, financialmarkets@fsdafrica.org, after this webinar. We'll also send a brief summary of the webinar and how to follow up to everybody on the call so that you can get in touch with the team. Right, so Evans, first question. Senfree would like to know a little bit more about the links between the insurance sector in Africa and capital markets.
Okay, yeah, thank you very much, Joe, for that. And there are also links between the insurance sector and the capital markets, and I can maybe talk about two broad links. The first one is as an investor. So as you know, insurance markets are very good at mobilizing long-term savings, and that could be invested in the capital markets. So that's a very strong link that we have between the savings mobilization ability of the insurance sector and the capital markets. In addition to that, insurance sector also provides products in the capital markets, so they can provide collective investment schemes, which again mobilize savings from the investors in the market for onward investments. And then also insurance companies play a very strong role in terms of risk management in the capital markets. So those are some of the links that we have between the insurance markets and the capital markets, and they are very, very strong.
Evan's next question is from USAID, and it's also from Duncan. So we know that capital markets mobilize long-term savings and allocate them to various parts of the economy. Do you have an example of where this has been particularly developmental? So, for instance, in the health sector, is there a transaction you can think of that helped fund the extension of health services?
Okay, no, thank you, John.
Or if it's not health services, maybe a transaction in the agriculture sector or an economic sector that we know is particularly developmental because it grows in a job-intensive way or a productivity-enhancing way.
Okay, so thank you, Joe. So we have very many examples of productive sectors that have come to the market to raise capital, and I'll give you a few examples around that. But if you look at the social sector, the health as well as education, I do strongly believe that the capital markets can also serve the needs in those two sectors, especially if you are talking about health or education services that have revenue generating potential. There's no reason why those entities cannot be able to come to the market and raise funding, for example, through the bond market for investments into infrastructure or equipment, and therefore be able to reach many more people and provide better quality services. So I believe that they can be served very well through the capital markets. In addition to that, let me just also illustrate one other partnership that we have that also demonstrate how the capital market can actually support, these segments. So we do have a memorandum of understanding with the WWF, which is the Worldwide Fund for Nature, and it's to develop innovative financing concepts around conservation, and that could include coming up with development impact bonds that enables the private sector to play a bigger role in financing conservation-related investments. So those are examples. But coming
Thanks,
to
Evans. Oh, sorry, go ahead.
Yeah, sorry. So coming back to the real sectors, we've had a number of entities that have come to the market to raise funding on the infrastructure side. As for example, Kengen in Kenya a few years ago raised about $300 million that was invested into geothermal. And that, of course, improved the ability to connect very many consumers to power. We've also had a few examples of manufacturing companies that have raised money from the market, and also agriculture businesses that have also raised money from the market in different markets, including Cote d'Ivoire, including Kenya, and including South Africa as well. So there are very many examples, and I'll be very happy to share such examples of entities that have raised money in the market for those productive sectors.
Thanks, Evans. And just to finish off on that line of thought, someone's asked about housing finance because it's a big challenge in Africa. Yeah. Are there any specific examples of housing finance transactions that you know of in the capital market space in sub-Saharan Africa?
Yes, so we've had quite a number of examples of housing finance companies raising funding from the capital markets. Ghana Home Loans is a very good example of that. We've also had CRRH, which is a secondary liquidity facility in Cote d'Ivoire, serving the Wamu region, that has raised money from the capital markets. We've also had the housing finance company in Kenya, housing finance company in Uganda raising funding from the capital markets to support their mortgage business. And there are many other examples that I can provide as well.
Great, thanks. The next question is about moving beyond the kind of classic big capital markets in Africa. So moving beyond South Africa, Kenya, and Nigeria. How can we start to work in more difficult places in the capital market space? And does that start from diagnosis? And if so, how does that happen?
Okay, yeah, no, thank you, Joe. Of course, as you move away from some of the larger markets, the challenges you come across then become a little bit more difficult. So, for example, maybe the regulatory environment or the political environment becomes a little bit more challenging. Maybe the scale becomes less, and therefore the cost of transaction becomes much more difficult. And therefore, as you work in some of these more difficult places, it is essential to be able to know what kind of capital market will support the aspirations of those countries. So not every country, for example, will need a stock exchange. Perhaps developing a professional market will probably serve the needs of the country much better than others. And then you also have to start also thinking how to develop the investor base in those countries as well, because without investors, you cannot be able to have a robust market or have an ability to attract the investors in those markets. So there are a number of things that you could do, and I think the question is how do you develop a market that is fit for the country that you are looking at.
And a good example, perhaps, of this, Evans, is your team's recent visit to Zimbabwe on a scoping mission to better understand the capital market ecosystem there before we start to do any work.
Yeah, exactly. So scoping diagnostics is definitely very important. So you have to understand the market, and you have to understand
question about regulators.
Mm-hmm. Sorry, Joe, I didn't get the question about the regulators.
There's a bit of delay my end. Sorry, everybody. So the question about the regulators is that in some small capital markets, the capital market regulation function is housed within a central bank. When is the right moment, or can you think of any examples of when that function should be moved to a separate entity like a capital market authority or an exchange an exchange commission?
Yeah, no, thank you, Joe, for that. I think as you start in a relatively small market, obviously you'll be concerned about economies of scale. So generally, that's why in a number of places, you have the central banks beginning to start being the regulator for the capital markets. And there are some very good reasons for that, because then they have the capacity, the cost, the transaction cost that they might pass on to the market will not be huge. But the mindset of most central banks is not necessarily around long-term financing. It's much more concerned about the money markets, much more concerned about monetary policy, stability and all that. So it's not necessarily a very natural fit. So over time, you could expect that that function will move to a dedicated authority that has the focus for long-term markets. However, as I mentioned before, that regulatory space that you get can become a cost to the market. And therefore, the market has to have some sort of a scale that will enable the transaction cost that arises out of having a relatively top-heavy regulator absorb within the market without causing a hindrance to market development, and ensuring that there is adequate resources that will enable the regulator to actually perform its role of ensuring fairness in the market and also supporting market development. So it's more an art, I can say, rather than a science, but a lot of that has to do with the scale and the ambition that the markets may have, all the potential that this market may have, and therefore the ability to absorb higher regulatory costs.
We've got a question from Beatrice about banks and capital markets. She's asking a question about the fact that banks are able to provide long-term finance in addition to capital markets providing long-term finance. And she sees that as potential competition. But are we able to encourage those two different groups, the banks and the capital market operators, to collaborate?
Yeah, no, thank you, Joe. And I think the issue of banks and their role in capital markets is actually quite interesting, because it's complementary in some cases, and in some cases it can be seen as competing. But just to demystify a little bit, the banks rely a lot on short-term deposits, and therefore the ability to lend long-term is actually very constrained, and it's going to be much more constrained as the regulatory space narrows in that area, because of adoption of international financial reporting standards. So the ability to lend long-term is going to be very constrained, going forward, because they won't want to carry a very big mismatch between their very short-term liabilities in the form of deposits, and of course the goal of generating long-term assets in terms of the loans and that they are providing. So what we have seen banks do to respond partly to that challenge has been to come to the market and raise long-term financing themselves. So if you look across Africa, most of the issues of corporate bonds in Africa are actually banks. And that's actually not very unique to Africa. Even in other markets, banks are major players in the capital markets as issuers. So they raise bonds, which will be long-term, and then they use the proceeds from those bonds to own lend. So that becomes a very complementary way of working in the capital markets. A number of bank holding companies also have subsidiaries that provide services to the capital markets in terms of investment banks and all that. And that's also very interesting. We've also seen move towards securitization, so mortgage securitization. So banks can originate mortgages, but the mortgages can be packaged and then subsequently sold in the capital markets through the bond markets and all that. That's another complementary way in which banks and the capital markets can coexist.
Great. I want to respect everybody's time. We've been on the line for about an hour. So perhaps one more question, Evans, before we wrap up. It's a question from Joseph, and it's about the fact that we've been, over the last 10, 15 years in the development sector, very focused on the poor, underserved segment. And he's wondering how these informal sectors and segments can participate in capital markets, and whether Emma Kiba might be a good example of that.
Yeah, no, thank you for that question, Joseph. I think, yes, as I mentioned, I think there are very many complements between the work that we've been doing around inclusive finance and the capital market development. And I think I mentioned about 4 channels around that. The Emma Kiba type of investments will be very interesting. And we see that as an opportunity to democratize the debt markets, because it provides the savers an opportunity to invest in a relatively risk-free instrument that has a much better yield than what they can get from depositing their money in the banks. So that's a very huge compliment that we see there. And it might also provide an opportunity for these investors to save gradually over time, and therefore create a pool of assets that will support them when they're not actively working during their retirement.
Okay, we better start wrapping up. Thank you very much to Evans and his team for giving a presentation. And thanks everybody on the line. I think we had close to 50 groups of people in the end, which is great. I think we'll try and repeat something like this over the coming months, just to go into a particular topic in more detail or broaden what we've talked about today. But if you'd like to follow up with Evans and his team in the meantime, we've got an email address set up. It's financialmarkets@fsdafrica.org. But also you can contact Evans and the team directly. I think you have their email addresses on the webinar invite. But thanks very much. I hope you enjoyed it, and I hope you'll hear from us soon.
Thank you.
Thank you.